Hello everyone. In this video, we are going to discuss various rules of debit and credit and journal entries. So we have discussed in the last video various golden rules of accounting, on the basis of which we prepare the journal entries. So we have discussed three types of accounts. One is personal account, another one is real account, and nominal account. So personal account deals with person, and therefore the rule for personal account is debit the receiver, credit the giver. The rule for real account is debit what comes in, credit what goes out. And in case of nominal account, the rule is debit all expenses and losses, credit all incomes and gains. So in a nutshell, we can see the rules of debit and credit on screen, which is debit the receiver, credit the giver, debit what comes in, credit what goes out, debit all expenses and losses, credit all incomes and gains. So personal account, when we talk about, these accounts are recorded. These accounts record a business dealing related to a person or a firm. The rules of this account says debit the receiver and credit the giver. The person receiving something is given a debit, and the person, if he is receiving something, is given a credit. The person who is giving something is given a credit, and the person who is receiving something is given a debit. So real account, when we talk about, these are the accounts of assets and all tangible things. The rules of this account says debit what comes in, credit what goes out. It means assets entering the business are given debit, and the assets going out of the business are given a credit. For example, purchase of goods for cash. So here we are taking the goods in the firm. So we are bringing the goods in the firm, and we are paying cash. So therefore what we are doing is cash is going out of the firm. So therefore real account rule will apply. Goods and cash both are real. Nominal account, this account deals with all expenses, incomes, profits and losses. The rule of the expenses says debit all expenses and losses and credit all incomes and gains. For example, rent paid to the landlord, it means rent expenses will be debited and it is the expense, and cash expense will be credited at as it is going out. Talking about the journalizing. And before we move on to the journalizing, we talk about the basis of accounting system. Cash or receipt basis. This is the method of recording transactions under which revenues and costs and assets and liabilities are reflected in accounts in the period in which actual receipts or actual payments are made. Receipts and payments account, in case of clubs, societies, hospitals, etc., is the example of cash basis of accounting. Accrual basis of accounting or mercantile basis of accounting is the method of recording transactions by which revenues, costs, assets, and liabilities are reflected in accounts in the period in which they accrue. The basis includes considerations related to outstanding, prepaid, accrued due, and received in advance. Then we talk about double entry system of accounting. So double entry system owes its origin to an Italian merchant named Luca Pacioli, who wrote the first book on double entry system of accounting in the year 1494. This system is based on the principle that for every debit there is a corresponding credit. Every business transaction has two aspects. that are when we receive something, we give something else in return. So there is always a give and take relationship. This method of writing every transaction in two accounts is known as double entry system of accounting of the two accounts. One is given debit while the other account is given credit with an equal amount rule of double entry system. There are separate rule of double entry system in respect of personal accounts, real accounts, nominal accounts. So all the three rules that we have discussed so far, they are a part of double entry system. That means every transaction that is taking place in the firm, we are going to have two accounts which will be affected in the books of accounts. So every transaction has two aspects. One is debit, another one is credit, and both the aspects are to be recorded in the books of accounts, and therefore this becomes the double entry system of bookkeeping. So what are the various advantages of double entry system? It provides a complete record of the financial transactions. It gives accurate information of amount due to and due by the business at any time. Arithmetical accuracy of the account books can be tested by preparing a trial balance by taking balance of all ledger accounts. It is helpful in preventing frauds and errors by preparing the trial balance. It is helpful to ascertain the profit and loss of a particular period by preparing the profit and loss account. Financial position of the business entity can be ascertained by preparing the balance sheet. Now, what are the various disadvantages of the double entry system? Now, this system requires maintenance of a number of books of accounts. So many books are to be prepared under double entry system. That is one of the one of the disadvantage of the system. This system is costly because a number of records are to be maintained. So we need to spend huge amount of money in order to prepare the books of accounts. There is no guarantee of the absolute accuracy of the books of accounts, despite of the fact that the agreement of the trial balance, because there are some errors like errors of principle, error of omission, compensating errors, etc., which remain undisclosed despite of agreement of the trial balance. So even if the balance sheet matches, even if the trial balance get tallied, there is no guarantee of the accuracy. So in case if we have not recorded any of the transactions that has happened in the firm, and we try to forget to make an entry into the books of accounts, in that particular case also the books will tally, and it would be very difficult, extremely difficult for the management to identify those transactions which are not recorded in the books. And if suppose there is an error of principle, which means that if the for example, if purchase of machinery is recorded as purchase of stock, so if this kind of an error happens in the firm, that creates a problem, because the trial balance will match and the balance sheet will also match. So it is very difficult for the management to locate the error, right? And there are compensating errors, which means one error compensate the effect of other error. That means suppose if on the debit side I have written by mistake from 5, instead of 500, if I have written rupees 50, and on the credit side also similar mistake has already, has also happened. So instead of 500 I have written 50. So in both the cases two errors have taken place, but since these are of kind of similar amount and the effect of one will offset the effect of other, therefore that is a possibility that the location of the error or finding out the error becomes difficult. So in that particular case also the trial balance matches and the balance sheet also will match. So it would be again difficult whether these are, there are errors or not errors. So it is not a guarantee. if the balance sheet matches, it is not a guarantee that the absolute accuracy is there in the books of accounts. So there are certain disadvantages or limitations of the double entry system as well. Talking about the events and transactions. So events, there are occasions which cause changes in the value due to time element. Outsiders are not concerned directly with such changes. For example, interest accrued, depreciation on assets, or meeting of board of directors, strike, efficiency of employees, etc. These are events. Only monetary events are recorded in the transactions. So all the transactions are events. Through all events, though all events are not transactions. So transaction, any exchange of goods or services for cash or on credit by the business with any other business is called transaction. It is an economic activity of the business that changes its financial position. So, what's the difference between transaction and events? Transaction is a consequence of exchange. Any exchange, if takes place, becomes a transaction. It can also be external. It is an economic activity. That means it involves money. So, exchange that we are doing for is the money exchange that is taking place. It can involve more than one party. It involves quantitative as well as qualitative changes. All transactions are events. So, talking about the events, it is a consequence of occasion. It is always internal. It is a historical activity. Only one party is involved. It involves only qualitative changes. All events are not transactions. Now we talk about the accounting trail. Now the accounting trail. The accounting trail or is known as accounting cycle or various stages of accounts can be summarized. We have already spoken about the accounting trail or the process of accounting in the multiple videos that we have discussed previously. So let us have a quick recap. So we identify the transactions with the help of the vouchers. Then we try, if the transaction is a monetary in nature, we start recording in the journal, and if it is non-monetary, what we do is we ignore that transaction. So once the transaction is identified as a monetary transaction, what we do is we do recording in the journal, and then we do classification in the book called ledger, and we start with summarizing through the trial balance. Once we prepare the trial balance and it gets tallied, what we do is we next start with the preparation of the financial statements, and it is also known as preparation of profit and loss account and balance sheet. So talking about the journalization. So journalizing is the process of recording business transactions to the books of original to the book of original entry, and this is called journal. So journals are tabular records in which business activities are analyzed in terms of debits and credits and recorded in the chronological order. Now let us have a detailed understanding of what is journal. So journal may be defined as a book where transactions are recorded in a chronological order. Chronological order means date wise. It is to be recorded as it happens. It is called as a book of prime entry or original entry because all business transactions are entered first in this book. The process of writing a transaction in journal is known as journalizing, and the transaction written in journal is known as journal entry. So there are certain ground rules for journalization. Apart from that, we have seen the golden rules of accounting and three categories of accounts. We also have the modern approach for the preparation of the journal entries. So is there any increase in the asset or decrease in liability? It is to be debited. Decrease in the assets and increase in the liabilities is credited. Expenses and losses are debited. Incomes and gains are credited. Now this is the format of the journal. You can see on the screen that we have certain columns here. So first column that we have is the date. So I have told you that journal is to be prepared in a chronological order. So what we are going to do is, as soon as the transaction happens in the firm, we need to pass on the journal entry, and that is date wise. So date is mentioned in the date column. Particulars. Now this is the column for writing the journal entry and narration. So narration is nothing but the explanation of the journal entry. Then we have the ledger folio, LF. Ledger folio is nothing but the reference number to be given in the journal for the ledger. That means once we prepare with the journal entries, we are going to transfer these journal entries to the ledger. So in order to locate where we have transferred, or if we have to find some error, or we try to match up the, we want to revisit the journal entries through ledger. So what we are going to do is, we mention the journal number in the ledger and ledger number in the journal to have a unique mapping of the two books. Then we have two columns of amounts. One is debit, another is credit. So the amount which is to be debited would be written in the debit column. The amount which would be credited in the which is to be credited would be written in the credit column. So this is what we have, is we have journal entries. We need to do the journal entries, and we have these transactions. So Ram started business with a capital of rupees 10,000. So first job is to identify which two or more accounts are involved in this particular transaction. So the first entry that we talk about, Ram started business with a capital of 10,000. It means we have two things which are involved. One is the Ram's capital, another one is cash. So if nothing is mentioned, assume that it is cash. So capital and cash. So cash is a real account, capital is a personal account. So if real account we talk about, cash is coming inside the business, and therefore it has to be debited. Debit what comes in, credit what goes out. Similarly, Ram's capital, Ram is a personal account, so Ram is the giver of the giver of the capital, giver of the money, so therefore it has to be credited. So if we see in the journal entry, it will become cash account debit to capital account 10,000 in both the columns of debit and credit. And we have written the narration, that is what we have done in the journal entry. We need to explain that in the narration part, which is in brackets. So being commencement of business is done. So cash account debit to capital account. Moving on to the second transaction, he purchased goods from Mohan on credit. So here Mohan is involved because the transaction is done in credit and purchase of goods is done. So in that particular case, what we will do is purchases account debit because it is a real account, purchase of goods, and Mohan would be credited because it is a giver of the goods. So purchases account debit to Mohan account, amount is 2,000, debited and credited both. Then we have the transaction, he paid cash to Mohan. So Mohan account debit to cash. Mohan is the receiver of the cash. Cash is going out. So Mohan is the receiver. So remember the rule, debit the receiver. Mohan is to be debited. Cash is going out. So cash is to be credited. Then we have the fourth transaction. He sold goods to Suresh. So here sold goods means goods are going out. So since assets are going out, it would be credited, and Suresh is the receiver of the goods, so he would be debited. So Suresh account debit to sales account, and amount would be 2,000 each. Moving on to the next transaction, he further purchased goods from Mohan. So he further purchased goods from Mohan. That means goods are coming in and Mohan is the giver of the goods. So purchases account debit to Mohan. Here purchases account debit to Mohan, being purchases of goods from Mohan, 2,000 rupees, both the columns. Then we have he sold goods to Suresh. So Suresh is the receiver of the goods and goods are going out. So receiver, that means to be debited, and goods are going out, it is to be credited, which is Suresh account debit to sales account. Then we have received cash from Suresh. So cash is received, that means cash is coming in from Suresh, means Suresh is the giver of the goods. So cash is coming in, cash account debit to Suresh account. I hope you have understood. So you need to focus on the rules that we have discussed, the three categories. So once you are through with the rules, you will be able to easily prepare the journal entries. So you need to first identify which all accounts which are involved in the transaction. Then the accounts which are involved, you need to identify what kind of accounts they are, and then based on the rules which are given to you, you need to prepare the journal entries. One more example in front of you. Mr. Modi started business with cash 50,000 rupees. Now here Modi is the owner of the business and he is bringing cash in the firm. So what we have done is cash is coming in the business, therefore cash account debit, and Modi's capital, because he is the owner of the firm and he is bringing the money as an investment, so therefore capital account, and this capital is the personal account and Modi is the giver of the account, so therefore capital account would be credited with the amount. It is by mistake it is written 1 lakh in the entry, it has to be 50,000. Then purchased furniture for rupees 10,000. So students, there is certain mistake in the amount of the question. So you can read the question, the first entry as 1 lakh, second transaction as 20,000, third transaction as 30,000, fourth transaction as 80,000, and fifth transaction as 10,000. So you need to please make sure that the amount matches with the journal entries. I think there is a discrepancy between the amounts here. So write down the amount, revise the question with the amounts which are mentioned in the answer. All right. So talking about the purchase of furniture, so furniture is purchased, furniture is coming in the business and it is purchased for cash, so therefore cash is going out, so entry would be furniture account debit to cash. Then he purchased goods for amount, and purchase goods means purchases of goods are coming in and against cash, so therefore cash is going out, so debit what comes in, credit what goes out, and purchases account debit to cash account. So when we talk about sold goods for cash, so goods are going out, so sales account is credited, and against cash, cash is coming in the firm, so therefore the real account rule will apply. It would be um, cash account debit to sales account. And then paid salaries. Salary is a nominal account. So nominal account, debit all expenses and losses. So expenses is your uh, debited, salary is to be debited, and cash account written is nothing but, it is by mistake it is written as return here, nothing but the cash account. So this is salary account debit to cash account, since cash is being paid as salary. So guys, I hope you have understood the concepts, and you need to first apply the rule, identify the transactions, apply the rule, and then prepare the journal entries. Now we move on to what is a secondary book and what are various types of secondary books. After recording all the business transactions in the primary books called journal entry, journal, it requires to identify the nature of various transactions recorded in the primary books and giving an appropriate name to the identical class of transactions. All entries are recorded in another set of books called secondary books. It is secondary because transactions are recorded for a second time. The secondary book is also called ledger. Now we have various types of secondary books. Secondary book can be broadly classified as journal ledger, general ledger, debtors ledger, creditors ledger, etc. So talking about the general ledger, it is a self-sufficient secondary book in the sense that all entries in the primary book will be posted directly or indirectly in this ledger. Debtors ledger will have separate accounts for each customer, and it will show the transactions entered into with the customers. For example, sale of goods on credit, collections from the customers, goods returned by the customers, discount allowed, bad debts, final balance due from them, etc. Creditors ledger, it will have a separate account for each supplier and will show the transactions entered into with the suppliers. For example, purchase on credit, cash paid to suppliers, goods returned, discount received, and finally the balance due to them. Now, what is ledger and explaining its necessity and usefulness. Ledger is the principal book, contains all accounts relating to assets, liabilities, capital, revenue, and expenses to which transactions were directly transferred from the journal. It is also called a final entry. Ledger is the ultimate destination of all the business transactions. Now, the necessity or usefulness of the ledger. Transactions related to a particular person, item, heading of expenditure or income, etc., are grouped at one place. When each account is periodically balanced, it reflects the net position of that account. Ledger is the foundation stone for preparing the trial balance. As the entries recorded in the journal are transferred to ledger, the possibility of errors are reduced to minimum. It is a destination of all entries made in journal or subjournal. Now, what is trial balance and what are the objectives of preparing the trial balance? A trial balance is a schedule or a list of balances, both debit and credit, extracted from various accounts in the ledger, including cash and bank balances from the cash book. Since every transaction has a dual effect, the total of debit side and the credit balances extracted from the ledger must tally. Thus, at the end of the accounting period or at the end of each month, the balances of the ledger accounts are extracted and a schedule of debit and credit balances is prepared to test as to whether the total debits are equal to total credits. Such a schedule is referred to as trial balance. Now, what is accounting equation? All the business transactions are recorded as having a dual aspect. At any point of time, a firm will possess things which may either be sold or converted into cash, or which may be later used for a fairly long time. All these things are called assets. Building, land, machinery, furniture, stock, debtors, bills receivable, cash at bank, cash in hand, etc. are a few examples of assets. The proprietor of the business brings capital into the firm, out of which the business purchases assets for its use. Thus, the amount of the assets of a business is equal to the amount of capital contributed by the proprietor of the business. So, accounting equation, when we talk about, we are trying to balance out the resources and the obligations that we have in the firm. So, we are matching the two sides here. Resources we are referring to the assets and the obligations we are referring to the liabilities. So assets and liabilities are always equal. That is what the equation is. So liabilities can be external liability, can be internal liability. So what we have is we have external and internal liability. So internal liability is also known as capital. We have already discussed the same in the videos previously. And so therefore external liability, when we talk about, it is simply termed as liability. So when we talk about the liabilities, we have capital plus external liabilities. So when we are matching the two sides, what we say is assets are equal to capital plus external liabilities. That means what we are saying is we are referring as whatever amount of money that has been spent in the firm as assets, they are supported through the amount of money that has been raised in the firm. Or vice versa is also true. Whatever amount of money that has been raised from the external sources or from the owner have been invested into assets of the firm. Therefore, the two sides must be equal. I hope you have a great learning in the previous videos as well as in this video. And I would wish you all the best for the future videos. Thank you.